Hi everyone, I hope everyone is good. Well, today we are back to talk about derivative part 2, chapter 4 over here. Let me just minimize this. So, where can you find derivatives? They are actually all listed on the Singapore Stock Exchange website, SGX, right? So you can see that over here, you can see a wide range of Singapore Stock Exchange derivatives that's available for trading, right? Right from bonds, future, options, exchange rate, LIBOR rate, right? Euro, dollars. So there are quite a wide range of things you can actually buy online. Okay, let me just switch to the Singapore Stock Exchange. There you have, this is one of the main page, right? You can see right at the top, there's the derivatives, which is what we are doing now. And if you look under products, okay, they got wide range of products, right, which is here, right? So you can see wide range of products that they are offering. The various future options again, they have a wide range of commodities that you can buy, like gold, uh, oil, coal, rubber, right? Anything you want, right? It's basically all tradable online. So if you seriously want to know more, you can actually go to the XGX website to take a look, right? To look around to see what's of interest to you, right? So here you have, there's a drop down box. You can see the various range of derivatives available with some of the open interest price, the settlements, the volume transacted for the day. So these are all the futures, okay, derivatives. So here there are also a range of information where you can find. Okay, it's not just on the SGX website. You can actually purchase a future derivative even in banks, local banks, right, like DBS, Vickers uh, Securities, right? So on the DBS website, you can also find lots of information about derivative, about trading on the financial futures, right? So you can go there, you can look at some of the spot forex, gold price, commodity futures. Um, they're all over the place, right? So DBS, you can go to DBS. Other local bank like UOB, they also trade, uh, do future trading, right? So there you can again find some of the services or products that's actually available, right? Other than local bank, you can also find derivative tradings available at some of the financial institute like Goldman Sachs, right? This is the Goldman Sachs, right? They also offer wide range of security products, ranging from again all the commodities, whether you like to trade your foreign exchange, right? Currencies exchange, equities, or any others. So um, so if you are keen, you can actually learn more, and there's actually a wide range of job opportunity for you if you are able to master this well, right? So other than Goldman Sachs, you also have Bank of China, Bank of America. They also do this kind of alternative investment schemes that's actually available, right? So JP Morgan, this is one of the big future option trading companies. So they also offer wide range of services, financial instruments, security services, treasury services, right? Everything you like to find out, anything you want to trade, they can actually customize even forward contract for you, right? So these are all tradable items, and there are many. Morgan Stanley, right, also available in Singapore, right? So Singapore is really a financial hub. So they have all these financial institute that basically offer all this wide range of investment scheme or derivatives, right, where you can use it, okay, for your business or as an alternative investments, right? So a lot of investors like to basically use Singapore as a main financial hub, okay, for some of these trading purposes, right? So so you must know that in business, there's always a lot of market risk. There's always a lot of financial risk, right? Things happen, right? And that can cause a great substantial financial loss. So in order to manage some of these financial uncertainties, so there are all these instruments and derivatives that we've been talking about to try to, in a way, to reduce, okay, reduce the losses, right, that can happen in times of uncertainties, right? So these are all some of the inventions, so-called, right, that people use to basically mitigate some of the risks. So derivative is what we know is an excellent tool to be able to hedge some of these risks, right? So people use it, institutes, personal people, okay, business people, they all like to play around this, okay, especially if you're a manufacturer or you're a farmer, they can also use these derivatives to hedge against some of their price, their product price, so that they can fix a future price that is of certain comfort to them, right? At least it's profitable for them to continue to do manage their business, right? So hedging is definitely recognized as a way to reduce financial risk, right? Uh, so they basically use some of these gains that they make in the derivatives to basically compensate some of the real losses that they have in the market. So you can say as a kind of leveraging, right? So when we talk about leverage earlier, we did talk about this leveraging, where you use a certain portion or a margin of your position value to basically hedge against some profits. Okay, so you don't use the cost of all the market value, right? So basically, you can use a percentage or margin of it to basically cover some of your risk, right? So speculators use leverage extensively, right? Because sometimes they don't have a lot of capital, so they can rely on this leveraging mechanism to basically use a bit of their capital and bet against good times, right? Of course, when things turn out bad, they will also get to lose big, right? So hedger also use leverage to basically, like I say, we keep saying managing the risk, right? It's also a way like buying insurance, right? Like when you travel overseas, you buy travel insurance, right? And sometimes that costs you less than $100 for a family package, right? But that can actually cover you in the events of accidents where or some things happen or even flight delay, right, or luggages, loss of luggages, and some of these could amount to big amount of money. But with insurance, they are able to have you were able to enjoy a large payout with just a small percentage of insurance premium that you need to pay. So this is a kind of like leveraging, right? So there are four basic types of risk. Right? We're going to talk about four basic: credit risk, market risk, operational risk, and strategic risk. Right? So these are the kind of a number of risks that can happen. Okay, so let's take a look at the first one: credit risk. Right? Credit risk is the risk where your counterpart fail to honor the agreement. Right? So uh, so so in stock exchange, right, especially when you buy stock and shares over the counter, right, over the stock exchange, usually you have this stock exchange that act as a middleman to minimize your credit risk, right? Because in stock, you buy things or if you trade through stock exchange, they are the middleman who basically try to do the settlements every day, right? And with all these daily settlements, the chances of you running away is slimmer, right? So the stock exchange in a way actually help in terms of covering some of your credit risk when you're supposed to pay up but you didn't pay up, right? So it's just like you never honor your part of the obligations, right? So you prevent people from running away without payment, right? So if you have settlements that is done every day, usually you can't run very far, right? So settlements is usually done every day by the clearing house. In this case, it's the stock exchange. So that in a way, if settlement is done every day, the risk of you running away too far will be slimmer. So that's having a credit risk. Market risk, right? So what does market risk involve? Market risk, like I say, in markets, the price fluctuates every day. Okay, take for example the oil price, right? Currently, we have a crisis where you have a virus outbreak, and that caused what? A lot of country locked down, right? They ban people from traveling, and in this way, what happened to the oil price? The oil price suddenly drop. Why does it drop? Why does the oil price drop? Because out of the sudden, right, all the airplanes are not flying, and the plane are not consuming the oil. Okay, you must know a plane actually consumes lots of oil, and suddenly many countries they have many planes, but not all the planes are all grounded, and then out of suddenly you have a great supply of oil, right? Where you have a lot of oil, but nobody is buying that. So when you have a great amount of supply and the demand is low, what happens to the price? The price, oil price will drop, right? So every day you have this risk that can happen. Okay, political risk, uh, virus outbreak, right? So price will fluctuate according to supply and demand, right? So price can vary. So nobody can tell what's next day will happen, right? So that can also have an impact on the demand and supply of certain product. So that's market risk, right? That fluctuate against the volatility of the market price, okay, against supply and demand, right? So people basically try to use derivative, right, to hedge against some of this uncertainty, right? So for example, if you are producing oil, you would like to fix the amount of oil, the price of oil, so that uh, as we always mention, the price will always be sustainable as profitable, right? Your selling price can always be higher than your cost price. Okay, so that's when you try to hedge against some of this adverse price movement that can happen, right? The adverse price movement. So derivatives would usually try to take advantage, and that's where people will try to use derivatives as a way to offset, okay, the risk that they have. Operational risk, okay, these operational risk could be what? Settlements, okay, where the settlements of your cash of collecting the money, okay, is not fast enough, right? And that you can run into a cash flow problem, right? Or your your when you supply your products to someone, and then the someone take your product and then they fail to pay you, right, on time, and then you need the money to pay your creditors, right? So you are caught in the mix, right? So there are people who default on payment, which means they never pay on time, and that could cause a lot of problems, because if you are running a company, you have to pay your employees on time every time, right? So if your 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 customers are not paying you, then how are you going to pay your employees? Okay, so there's always this cash flow issue that you need to manage. So timing of cash coming in is very important. So when you do a business, always you will try to uh, take money first, right? Cash is king. So you always like to settle things with cash, right? Cash on hand is better than no cash at all, because uh, you come to a time where your creditor comes to you and asks you for money, and then you got no money to pay them, right? They might sue you for bankruptcies, right? They will sue you for payment, and you might be declared bankrupt, right? So there are a lot of implications in doing business, right? There's also the legal risk that could also involve where you go into a business contract where you never read carefully or the business contract cannot be enforced. Like for example, you do a business with somebody and then you already done the services and then yet okay the person don't want to pay you because of all legal compliance, whether you didn't comply certain things. So there could be a lot of arguments, or it could be what your again your customer okay suddenly go bankrupt, right? Then you can't get the money from them. Okay, so these are all legal implications that could happen in any business. So that will actually classify under operational risk. Means day to day, right? So day to day operation, collecting money from your customers and getting them to pay you on time, so that you can pay other people, right, on time also. Strategic risk. Okay, strategic risk is basically about strategizing, whether again coming back to doing business, right? So you could be doing a lot of market survey, and then you deem that to produce certain products, okay, it's going to be very profitable and it's going to be marketable. But once you mass produce and come out with the product, and then later on you find that cannot sell, there's no buyer, right? Which actually contradict with your market survey. That's quite common, right? You think that it's sellable, now coming out with a new product, or like for example, you come out with a new iPhone 12, okay, great features, and you thought it's good, customer, there will be a lot of consumer buying. But later on, when you launch a product, nobody is buying, ended up, right? So you might be caught in a lurch, right? So basically, it's about misread some of the client requests. So you have to be careful about doing market survey. Sometimes the market survey are not reflective of who people actually buy, right? So or sometimes your production costs could get out of control, right? So you have certain selling price that you have set, okay? Then you later on find that your cost price of the product actually exceed your selling price. Okay, so you can't just anyhow increase your selling price all the time, right? So you have to keep a tab on your production cost. So when your production cost is getting out of hand, getting out of control, you might find that the production cost, the operation cost can exceed the selling price. And then when the situation comes, you find that basically you're losing business, right? Your business just not going to work out, right? Because you are basically selling things at a loss. Okay, so these are all important case strategic risks that you have to take note and you have to bear, right? If things doesn't work out well, right? Just like some people want to set up a restaurant, okay, along Orchard area. So one shot they invested in 3 shops, okay, doing all the renovation, getting the renowned chef to cook the meal, waitresses all employed. Every of the restaurants is very nicely decorated, right? With all the high quality foods that you offer. But then later on you find out that all the 3 shops, okay, all the 3 restaurants along Orchard Rating road is not selling, okay, they're not getting enough crowds into your restaurant to be able to break even. So that is also a strategic risk, right? So where you instead of opening one restaurant at a time, you straight away invested in 3 restaurants along Orchard area, right? So that could also be a strategic risk that you might undertake. Right, let's take a look at some example. This is just the preliminary. We'll go into deep on these options, right? So we will have one chapter later on this option trading. So this is hedging using options, okay, which means that you have an option to say no, right, and get away, right? So here we are looking at one specific option. Okay, later on you will find that the options got a couple of different options. So now we are particularly looking at a long put options, right? So what does a long put option means? Basically, it's the right but not the obligation to sell. Okay, here we are talking about the option for you to sell gold, and in this case it's gold at $800 per ounce, right? So this is talking about selling price. I can try to fix the selling price. You can also fix the selling price, or you can also fix the buying price. So if you're going to fix the buying price, then it's going to be a long call. But in this case, this is a long put. So we talk about fixing a selling price. Okay, so you can either fix a buying price or you can fix a selling price up to your contract. So this is the option that we talk about, fixing a selling price from the merchant point of view, right? So you can fix a selling price. So this is to protect against seller from, let's say, you think that the product's price is going to fall, right? Or like the house that you're going to sell is going to fall. You can go into a long put where you can try to fix the selling price because you know that in the future the selling price is going to fall, right? So you go into a long put. Okay, so that will protect you from price going down. But what happens if price going up, your selling price, right? The price, the product that you sell, the price can actually go. In this case, what happens if the gold price goes up? What happens if the price goes up? Well, if it go up, you still have the rights to say don't want to sell at 800. You can just walk away from this option. That's the beauty about this option. You are given the options, right? If the price, instead of going down, it actually went up. You have the options to say, okay, I don't want the 800 price. I don't want to set the selling price at 800 price. I can move on to sell something at the market price, which is 900, 1000, right? That is assuming that go the other way. So that's the advantage of having these options. So the option is basically to protect the seller from falling price. Okay, if the price goes up, seller no need such protection. They can walk away, right? But of course, they stand to forfeit the premium that they pay. They stand to forfeit the deposit that they're going to pay, right? That's why you have this graph over here, right? So here is actually a price. We'll talk about this graph later on in other the future chapters, but just to give you a few, right? So this is like when the price go down, okay, they have these long put options to basically help them to cover the losses, okay, if the price fall, right? So there is this gain that will help to cover the loss in price, and there's a default here. This is actually the premium that they pay. So if the price goes up, this is like the price goes up. If the price goes up, basically you'll lose the premium. That's this part of the thing, long put, right? Because they're going to walk away from this contract, right? They're not going to honor. They have the option. They just bought the right, okay, not the obligation to sell at this price, right? So if the price actually goes up to 900, right, 900, they will just simply lose the options, and they can continue to sell the the gold in this case at a higher price. Okay, so this is how the graph is turned out, right? Anyway, this for your early information. We'll come back to this graph right in the option chapters. So it's like insurance policies that protect the buyer against falling price. If you think the price is going to drop, okay. So in this case, this is a ABC mining company, right? They know the gold price is going to fall because of what? Maybe uh, there's a reduce in demand for gold, right? So the supply gone up, demand drop, so the price will drop, right? So this will at least help to secure a selling price for this ABC mining company, right? So that in the future, like 6 months, 10 months later, the price can be maintained at this selling price and it still remain profitable for the mining industries, right? So here is just a scenario, right? For example, this ABC company, a mining company, if the price drops, let's say 800, the price drop to 780 per ounce, right? This is the market price. They will have to sell the market price to the merchants over here, right, at 780, right? So this pay 70. So what happened here? They will lose $20, right, per ounce, but the shortfall is made up by the option, okay, that they have, so they can basically exercise the options and sell the contract at 80, and this is where the market have a gain of $20. So the gain from here, $20 here, will make up for the losses over here, right? So eventually that's how they fix the price, right? So there's actually two transactions going over here, right? Here is the real transaction with the merchants, and here could be a option contract with one of the financial institute or with the bank. And then because of this contract, long contract, right, will have a value, a gain of $20, and that's where they make the $20 over here, and then use that $20 to cover the losses over here, right? So $20 gain here with the $20 loss over here. Eventually that will even up, and that will be remain as the price as $800 per ounce. Okay, so this is how the payoff from one contract to cover the loss of the original transacted cost. Okay, so in conclusion, you'll find that hedging is not something that is free, right? In any case that you need to cover for some adverse, there's always a price that you need to pay, right? So you either pay for premium or options or insurance, right? So that you can help to cover some of the uncertainties that could happen, right? So it's a very complex topic, you can say, right? So, but it's something that there's always a demand. There was always a demand in both the companies as well as any business people, right? Where they will need to safeguard some of their capitals or investments. Okay, so with that, I will conclude with today's chapter. Thank you for your attention.